With the first 3 quarters of 2016 now in the record books, we'll provide in this video a brief overview of the year-to-date highlights and then outline our expectations for the upcoming elections. The first and second quarters of 2016 were hit with extreme price swings on the heels of China growth concerns and the surprising Brexit vote. All that volatility came to an end in the third quarter as no major news surfaced. In fact, markets experienced record low volatility in the third quarter of 2016. The S&P 500 index went 23 straight days in August and early September, moving less than 0.75% in either direction, the longest such streak on record. For the entire quarter, the index only had 6 trading days in which there was movement over 1% in either direction. Despite the low volatility, the S&P 500 index managed to grind out small gains, rising 3.9% for the quarter and is now up nearly 8% for the year. The tech-heavy NASDAQ composite was the star for the third quarter, earning 9.7%, reversing losses from the first half of the year. The big change in the third quarter was the material improvement in growth-oriented stocks compared to value-oriented stocks. Despite the improvement, growth still lags value for the year. So what can you expect for the rest of the year? In short, increased volatility. The coming months will undoubtedly be filled with election speculation. This will lead to increased volatility during the October-November period that has traditionally been marred with major price swings. Equity volatility in November of presidential election years has historically been 22% above the average for all months, and this year should be no exception. Markets are historically indifferent on Democrat or Republican winners. What markets really want is certainty and predictability. A Hillary Clinton win, coupled with Republican-controlled Congress, is the desired stability markets will likely reward. While Secretary Clinton has pulled ahead in recent polls, we must all be reminded polls can be quite unpredictable. The most recent example was the vote in favor of Brexit that few expected and the professional prognosticators clearly got wrong. As you will likely recall, the surprise outcome from the Brexit vote sparked a material sell-off in stocks around the globe. The U.S. presidential election could create a surprise outcome markets are ill prepared to tolerate. If a surprise outcome does occur, expect markets to correct by 5 to 10% in the short term and then make a quick recovery as investors refocus on economic fundamentals. When the dust from the presidential election has settled, investors will see a stable U.S. economy with low unemployment, rising household income, increased consumer spending, and a strong housing market. These fundamentals, coupled with what we believe will be a strong third quarter earnings season, will provide the foundation necessary to propel markets towards record highs by the end of 2016. From the entire HM Capital Management team, thank you for watching.